Candlestick patterns are usually the first thing that confuses beginners. And to be honest, they confused me as well when I first started trading. At first glance, a price chart looks like nothing more than simple red and green bars. But that's only on the surface. In reality, each candle contains a large amount of information that can help you make more accurate trading decisions. Unfortunately, even experienced traders often misunderstand key concepts related to candlestick patterns. And as a result, they end up losing money. That's why in this video, I've collected and structured everything you need to properly understand this topic. So let's begin. Welcome to Graph Insight. In this video, I'm going to show you some of the most powerful candlestick patterns that helped me grow my trading account over time. These patterns appear on the chart again and again, and very often they signal a potential future price move before it actually happens. But before we get into that, let's start with the basics. Let's break down what a candlestick actually is. Candlesticks consist of two main parts, the body and the wicks, an upper wick and a lower wick. Candles can be either bullish or bearish. Bullish candles are usually shown in green, while bearish candles are shown in red. But why are they classified this way? The key factor is the relationship between the opening price and the closing price of the candle. The time it takes for each candle to form is determined by the time frame you're using on the chart. For example, if you open a 15-minute chart, each candle will take exactly 15 minutes to form. The same logic applies to any other time frame. Now let's look at how a new candle forms from scratch on a 15-minute chart. The previous candle is bullish, which means the price closed higher than it opened. That's what defines a bullish candle. Next, a new candle opens. During those 15 minutes, price moves up and down, constantly fluctuating. When those 15 minutes are over, we see that the price closed below the opening price. As a result, this candle becomes bearish. From this, we can draw an important conclusion about the candle body. In a bullish candle, the lower edge of the body represents the opening price, and the upper edge represents the closing price. In a bearish candle, it's the opposite. The upper edge of the body is the opening price, and the lower edge is the closing price. Now, if the candle body is clear, what do the wicks actually represent? The wicks show the highest and lowest prices that price reached during the formation of the candle. In this case, during those 15 minutes. For example, we can see that price moved lower than the closing level, but by the time the candle closed, price pushed back up. That movement is what creates the wick on the chart. At this point, you might ask, why make things so complicated? Why not just use a line chart? And technically, nothing is stopping you from doing that. But the real question is how much information you're losing. A line chart only shows where price moved. A candlestick chart shows the battle between buyers and sellers through candle bodies, wicks, sequences, and patterns. If we use an analogy, a candlestick chart is a book. A line chart is just a short summary. Before we move on to candlestick patterns, let's talk about the logic behind how candles are formed. Because by looking at a single candle, you can often understand who was in control at that moment, buyers or sellers. This will help us make the right trading decisions. Take a look at this red candle. We can see that it has a small body and a long upper wick. This relationship between the body and the wick tells us that buyers initially pushed the price up to the high of the candle. But at that level, sellers stepped in and aggressively pushed the price back down before the candle closed. This indicates seller dominance and can suggest a continuation of a downtrend. Or if this candle appeared after an uptrend, it may signal a potential reversal to the downside. The same logic applies to the opposite situation. A candle with a small body and a long lower wick points to buyer dominance, showing that sellers pushed price down, but buyers stepped in and regained control. Now let's look at the next candle. Here we see a small body and almost equal wicks on both sides. This type of candle often indicates indecision in the market. Neither buyers nor sellers are in control, and this balance of power can also precede a potential trend reversal. Now that you understand the logic behind candlestick formation, we can move on to the most effective candlestick patterns. The first pattern we're going to look at is the tweezer bottom pattern. This pattern consists of two large candles. The first one is bearish, and the second one is bullish. A key requirement of this pattern is that both candles form at the same low. Their lows must be equal. This pattern signals that during a downtrend, price has reached a strong support zone. Buyers step in at this level, which can lead to a potential trend reversal. Now let's move to the chart. To identify this pattern, we first need to make sure the market is in a downtrend. Once we spot a formed tweezer bottom, we wait for confirmation. That confirmation comes from a bullish candle that forms and closes above the close of the second candle in the pattern. Once this happens, we can enter a long position at the close of the confirmation candle. The stop loss is placed at the level of the lows of the two candles that form the pattern. The mirror version of this setup is the tweezer top pattern. Here, everything works in the opposite direction. We see an uptrend, followed by a tweezer top formed by a bullish candle, and then a bearish candle with identical highs. We wait for the next bearish candle to form and close. After that, we enter a short position at the close of that candle, and we place the stop loss at the level of the highs of the candles that form the pattern. The next pattern is the bullish engulfing pattern. This pattern consists of two candles. The first one is bearish, and the second one is bullish. The key requirement here is that the bullish candle must completely engulf the body of the bearish candle. This pattern signals a potential trend reversal from bearish to bullish. It shows that buyers have stepped in with strong pressure and fully absorbed the selling momentum of the previous candle. Now let's look at how this pattern appears on the chart. To identify a bullish engulfing, we first need to make sure the market is in a downtrend. Once the pattern forms, we wait for confirmation in the form of the next bullish candle. The close of this confirmation candle becomes our entry point for a long position. The stop loss is placed below the low of the engulfing pattern. The mirror version of this setup is the bearish engulfing pattern. Here we see an uptrend followed by a bullish candle, and then a bearish candle that completely engulfs it. We wait for confirmation in the form of the next bearish candle. The close of that candle becomes our entry point for a short position, and the high of the engulfing pattern is used as the stop loss level. The next pattern is a single candle pattern called the Dragonfly Doji. The key characteristics of this pattern are a very small body, a long lower wick, and a short or completely absent upper wick. This pattern signals a potential trend reversal from bearish to bullish. In this pattern, the color of the candle does not matter. It can be either red or green. What matters is the structure of the candle. Now let's move to the chart. Here we can see a clear downtrend in a formed Dragonfly Doji pattern. Before entering a trade, we need to wait for confirmation in the form of the next bullish candle. The high of this bullish candle becomes our entry point for a long position. The stop loss is placed at the low of the Dragonfly Doji's lower wick. The mirror version of this pattern is the Gravestone Doji. Just like with the previous pattern, the color of the candle does not matter. On the chart, we can see a clear uptrend in a formed Gravestone Doji represented by a candle with a long upper wick and a very small body. We wait for confirmation in the form of a bearish candle. The low of this candle becomes our entry point for a short position, and the high of the Gravestone Doji's upper wick is used as the stop loss. In reality, there are many types of doji patterns, and you will encounter this term very often. A doji candle is a general concept that describes a candle with an extremely small body. Let's move on. The next pattern is the Morning Star. This pattern consists of three candles and signals a potential trend reversal from bearish to bullish. The first candle is bearish with a large body. The second candle represents indecision, usually a doji candle with relatively equal wicks. The color of the second candle does not matter. It can be either red or green. The third candle is bullish with a strong body. The key elements of this pattern are the indecision candle and the following bullish candle, which must close above the midpoint of the first candle. On this chart, we can see a downtrend in a fully formed Morning Star pattern. This setup allows us to enter a long position without waiting for additional confirmation because the third candle itself confirms the reversal. We enter the trade at the close of the third candle. The stop loss is placed below the low of the second candle. The mirror version of this pattern is the Evening Star. Here we see it forming in an uptrend. Just like before, we enter a short position at the close of the third candle, and we place the stop loss above the high of the second candle. The next candlestick pattern we're going to look at is called Rising 3 Methods. This is a bullish continuation pattern. It forms within an uptrend and represents a short consolidation before the price continues moving higher. This pattern consists of 5 candles. The first candle is a strong bullish candle with a large body. It is followed by 3 consecutive bearish candles with small bodies. These candles must stay within the price range of the first candle and should not break its high or low. The fifth and final candle is another strong bullish candle. It closes above the high of the first candle, signaling the end of consolidation and the continuation of the upward move. Now let's move to the chart. Here we can see a clear uptrend in a fully formed Rising 3 Methods pattern. After the final candle closes, we enter a long position at its closing price. The stop loss is placed below the low of the first candle in the pattern. The mirror version of this pattern is called Falling 3 Methods. Let's look at it on the chart. Here we see a clear downtrend in a Falling 3 Methods pattern. It starts with a strong bearish candle with a large body. This is followed by 3 consecutive bullish candles with small bodies that remain within the price range of the first candle. The fifth and final candle is a strong bearish candle that closes below the close of the first candle. The close of this fifth candle becomes our entry point for a short position, and the high of the first candle is used as a stop loss. The next pattern is relatively rare, but very powerful. It is called the bullish Marubozu. This is a single candle pattern that usually forms in an uptrend and signals trend continuation. The key characteristic of this candle is a large body with little to no wicks, which indicates strong buying pressure. On the chart, we can see this candle forming within an uptrend. We wait for confirmation in the form of the next bullish candle. The close of that candle becomes our entry point for a long position, while the low of the Marubozu candle is used as the stop loss. This pattern can also signal a potential trend reversal if it appears in a downtrend. However, most of the time it acts as a trend continuation pattern. The mirror version of this pattern is the bearish Marubozu. On the chart, it most often forms during a downtrend and signals trend continuation. Before entering a trade, we again wait for confirmation in the form of the next bearish candle. The close of that candle becomes our entry point, and the high of the Marubozu candle is used as the stop loss. The next pattern we're going to look at is the 3 white soldiers pattern. This pattern consists of 3 consecutive bullish candles. It most often forms in an uptrend and signals trend continuation. If it appears after a downtrend, it can also indicate a potential trend reversal. A key characteristic of this pattern is small wicks or no wicks at all, which shows strong and consistent buying pressure. On the chart, we can see this pattern forming within an uptrend. When trading this setup, we don't need to wait for additional confirmation. The entry point is the close of the third candle. The stop loss is placed below the low of the first candle. The mirror version of this pattern is the 3 black crows pattern. On the chart, in a downtrend, we can see 3 consecutive bearish candles with small wicks. This structure signals the continuation of the downtrend. The entry point for a short position is the close of the third candle, and the stop loss is placed above the high of the first candle in the pattern. Next, let's look at a pattern called the bullish spinning top. This pattern consists of a bullish candle with a small body and long, nearly identical wicks on both sides. It is a single candle pattern that represents market indecision. It is similar to a doji indecision candle, but in this case, the color of the candle matters and provides additional information. Most often, this candle appears during a downtrend and can signal a potential reversal to the upside. Now let's move to the chart. Here we see a bullish spinning top forming in a downtrend, which suggests a possible reversal. We wait for confirmation in the form of the next bullish candle. We enter a long position at the close of that candle. The stop loss is placed below the lower wick of the spinning top candle. The mirror version of this pattern is the bearish spinning top. Everything works the same way, except for the candle color. On the chart, we see it forming during an uptrend. We then wait for confirmation in the form of the next bearish candle. The close of that candle becomes our entry point for a short position, and the stop loss is placed above the upper wick of the spinning top candle. Now that you've learned the most effective candlestick patterns and understand the logic behind how they form, it's important to say that very often, candlestick patterns alone are not enough for a complete market analysis. To increase accuracy and confidence, these patterns should be used in combination with other analytical tools. In this video, I'm going to show you how to combine candlestick patterns with supply and demand zones. But first, let's briefly clarify what these zones actually represent. A supply zone is an area on the chart where selling pressure previously exceeded buying pressure. It is a price zone where sellers were strong enough to push the market down aggressively. When price returns to this area, sellers often become active again. A demand zone is the opposite. It is an area where buying pressure previously exceeded selling pressure. In this zone, buyers stepped in strongly and pushed the market higher. When price comes back to this area, buyers often defend it again. In simple terms, supply zones are areas of potential selling interest, and demand zones are areas of potential buying interest. Now let's see how combining these zones with candlestick patterns can significantly improve the quality of your trade setups. On the chart, we can see that price previously reacted to this area twice. Each time price reached this zone, buyers stepped in aggressively and pushed the market higher. This gives us a strong reason to believe that a demand zone has formed here. A zone filled with buy orders, where sellers are unable to push price lower. Later, we can see price returning to this demand zone once again. This time, it forms a reversal pattern in the form of a bullish engulfing. This tells us that the demand zone is still valid and has not been exhausted. As a result, there is a high probability that price will bounce from this zone again. For additional confirmation, we wait for the next bullish candle to form. The close of this candle becomes our entry point for a long position. The stop loss is placed below the low of the formed pattern. The take profit is set at the level of the previous major high. As a result, we can see price successfully following our scenario and reacting exactly as expected. To sum everything up, candlestick patterns are not magic signals. On their own, they don't guarantee profits. But when you understand the logic behind how they form, and when you combine them with key market zones like supply and demand, they become a powerful decision-making tool. If you found value in this video, make sure to like it and subscribe to the channel so you don't miss future videos. Thank you for watching. See you in the next video.